Now, friends, welcome once again to this session today. We are looking at revision. We are still looking at this May 2015. Now, this time round, we want to look at question 4. So, friends, remember, from our previous sessions, we have dealt with question 1, 2, and 3. We are now doing question 4, and later in another session, we'll do question 5. Now, from May 2015, question 4, this question 4 relates to group accounts, relates to the consolidated financial statements. Remember, International Financial Reporting Standard number 10 outlines the provisions of control, outlines the provisions of consolidation. Unlike in IS 27, where we were talking about the consolidated, the separate consolidated financial statements, the separate financial statements, we now talk about consolidated accounts in IFRS number 10. You need to remember that there are changes. You need to remember that we have the changes of IS 27 and IFRS number 10. IFRS 10 is the most recent and is the one that will be used in preparing consolidated financial statements. Unlike IS 27 now, we are using it to prepare the separate financial statement for individual companies. So you should remember that. You also need to remember the disclosures of IFRS number 10, they're in IFRS number 12. You should remember that. I thought you should know. At the same time, you should also know that we are not talking about IS number 31, but now we are talking about IFRS number 11. I believe you'll be learning more and more if you go back to our sessions that we have been doing in our website. For today, let's go to question 4 and answer that question purposely for revision. Now, in question 4, we are saying, X Limited, a company quoted on the Securities Exchange, acquired 960 million of the shares capital of Y Limited on 1st April 2011. X Limited also acquired 165 million shillings of the share capital of Z Limited. On 1st September 2011, at the time of the acquisition, the retained earnings of Y Limited and Z Limited were 480 million and 807 million respectively, while the fair values of the net assets of Y Limited and Z Limited were 2,400 million and 1956 million respectively. The financial statements of the three companies for the year ended that 1st March 2015 were as follows. We have the income statement for the year ended that 1st March 2015. We have for X, Y, and Z. We have the revenue, cost of sales, investment income, we have distribution, we have admin expenses, we have finance costs, we have the profit for the year, the retained earnings, the dividends, retained earnings carried forward. The statement of financial position is also given. Non-current assets, we have the current assets, we have the current liabilities, we have the current non-current liabilities. No, we have only current liabilities in this case. Additional information. 1. During the year ended at 1st March 2015, Y Limited sold goods to X Limited for 3,900 million. Y Limited made a profit of 30% on the selling price. 420 million shillings of these goods were held by X Limited as of 31st March 2015. On 31st March 2014, X Limited held 180 million of the goods that had been purchased from Y Limited at the same gross profit margin. 2. Annual impairment tests have indicated impairment loss of 300 million relating to the goodwill of Y Limited, which included 75 million shillings of the goodwill impaired in the year ended that 1st March 2015. The goodwill of Z Limited has not been impaired. 3. The fair value difference of the net assets of Y Limited relates to the plant being depreciated over a useful life of 10 years from the acquisition date, while the fair value difference of the net assets of Z Limited relates to land. 4. Y Limited intangible assets include 261 million being expense incurred on the staff training on the use of the new technology conducted during the year. The directors of Y Limited believe that the expenditure should be capitalized since the expense were incurred before the new business had commenced. 5. Y Limited has not issued new share capital since acquisition. 6. Investment income of X Limited relates to dividends received from Y Limited and Z Limited. Required: A. Group statement of comprehensive income for the year ended 31st March 2015. B. Group statement of financial position as of 31st March 2015. Now, from the required point of view, we are only required to prepare two items: the consolidated income statement and the consolidated balance sheet, only two. But for revision purposes, we may go further, friends, and prepare as well the group statement of changes in equity for the retained earnings only, for retained earnings column only, so that we are able to determine the group retained earnings. Secondly, from the required point of view, you notice that our financial year begins on 1st April 2014 and ends on that 1st March 2015. So our current financial year begins on 1st April 2014 and ends on that 1st March 2015. You should remember that as well. So that is a very important key area that we need to look at, especially for the purpose of determining the balances at the beginning of the year. Now, from the first paragraph, we can be able to tell that they have told us there are three companies. Let's see. X Limited, a company quoted on the security, acquired 960 million share capital of Y Limited. We acquired 960 million capital. We'll want to know whether Y is a subsidiary, an associate, a joint venture. That's what we want to know. So we can, or a simple investment to information. So let's try to know this. We percentage of control. Percentage, let me call it working one, percentage of control. We were not given. We were not given this. Percentage of control will be equal to the shares held or owned or acquired, you divide it by the total number of shares in the company acquired. You multiply by 100. Or you can say value of shares or debentures held, you divide it by the total value of shares or debentures in issue. Like in this case now, for Y Limited, we have acquired 960 million shillings. So we need to know the total value of shares in Y. We go to our statement of financial position. Under the balance sheet, under equity and reserves, there is 1,200. So how much is that gonna be? We have 960. That is 80%. This means that if we were looking at control from the percentage perspective, then it means Y is a subsidiary. You need to remember that according to IFRS number 10, a company is not a subsidiary merely because you own more than 50% shareholding. No. You can as well own less than 50%, friends, but you still have control. That's why we are saying there are differences between IAS 27 and IFRS number 10. Control does not only mean that you own more than 50% shareholding in the other company. Control can be where you own less than 50%, but there are some other constructive agreements that you may be having in the process, and you end up having control of that company, the fact that you own less than 50%. Fine. Okay, so for this, basically, we can say that subsidiary is these other companies are subsidiary. How about Y? X, sorry. On 1st April, X Limited also acquired 165 million of the share capital of Z Limited. Fine. For X Limited, sorry, not for X, but for Z Limited, we acquired 165 million. And the total share capital is 660. We can say that 165 divided by 660. So we can basically say that Z Limited is actually an associate. So Y is a subsidiary, Z is an associate, unless other constructive agreements or other agreements or circumstances are available to make Z a subsidiary. Fine. Now, we continue. From our analysis, at the time of the acquisition, we are saying at the time of acquisition, the retained earnings of Y Limited and Z Limited were 48 million and 807 million respectively. So remember, these are pre-acquisition retained earnings. Then we have respectively, while the fair values of the net assets of Y Limited and Z Limited were 2,400 million and 1956 million. So at the date of acquisition, we are being given the fair value. The reason why we are being given the fair value is to determine whether there was a revaluation. Now remember, Z is an associate. We may not bother so much about it. We may not want to determine the revaluation of the assets, but we may want to look at the revaluation of the assets in Y. Let's determine that. Come and say fair value so we simply look at to determine the revaluation gain. You compare the fair value on acquisition date and the net book value on the date of acquisition. Of net assets. So we can say that our fair value for Y Limited and for Z Limited is given as 2,400 and this 1956. Our net assets, one of them is the ordinary share capital. Share premium, friends. We also have pre-acquisition retained earnings. So that's the position. I can just subtract them, all of them directly, no problem. Like the ordinary share capital is 1,200. The share premium is 420. Pre-acquisition retained earnings we were given in the first paragraph, that is 480. For Y is 480. The other one is 660. And we also have, apart from 660, we have 249. Then we have 807. So if I take my calculator, I say 2 400 minus 1 200 minus 420 minus 480, I get 300. 1956 minus 660 minus 249 minus 8 or 7, I get 240. But now, we are not interested with the one for Z limited. We'll be interested with the one for Y limited because Z is an associate, as we must have said. So the revaluation surplus is mainly 300. We're interested with the one for Y limited. So if there is a revaluation, then our assets must have been, will be affected, the property, plant, equipment. The depreciation must be adjusted as well. We are going to see that. We continue. So we know that if we have the income statement, the balance sheet of X, Y, Z, we are not going to consolidate the incomes and expenses of Z, but we are simply going to consolidate the one for X and Y, the assets of X and Y. Z, we only bring in a few items. In the income statement, for Z, we only recognize the group share of profit after tax in Z. In our group statement of changes in equity, we are going to recognize the group share of post-acquisition retained earnings brought down of Z. In our statement of financial position, we're only going to recognize investment in an associate being Z. So friends, I repeat, there are mainly three items we'll talk about. One, the group share of profit after tax in an associate. That's of Z, and that's what will be reported in our income statement. Secondly, the group share of the post-acquisition retained earnings brought down. That will be reported in our group statement of changes in equity. Thirdly, the investment in an associate. That will be reported as an uncurrent asset in the statement of financial position. So there are only those three items that will be reported in our consolidated financial statements. But the rest we don't. We don't consolidate the incomes and expenses of Z. We don't consolidate the assets and liabilities of Z. You need to remember that, friends. Fine, we are going to do that, is not a problem. So that is straightforward, makes our life easy from, from the income statement given. We have even been given the dividends. We have even been given the retained earnings brought forward and all that. Sometimes you're not given either dividends or retained earnings brought down. You can work backwards and try to get it as a balancing figure, and you can remember some of the questions we have done in the past in our website, www.iamacademy.net. We have done similar examples which have very a little bit slippery. Now, in our statement of financial position, there's nothing very interesting. It's just obvious. Property, plant, equipment is what we are going to do. Intangible assets we only have for Y limited. Where investment in Y and investment in Z, those are purchase consideration. Investment in Y will use it to determine goodwill, while investment in Z will use to determine the investment in an associate. Current assets, we have inventory, we have accounts receivable, cash and cash equivalent, that's obvious. You need to remember these, friends. When it comes to property, plant, equipment, there is some adjustment we need to make to the PPE apart from taking the one for X and Y. We are going to adjust with the revaluation like the one we have of 300. We also need to adjust it with the depreciation under or overcharge. We also need to recognize it with unrealized profits or unrealized losses in case of intercompany sale or PPE. You need to also remember, when it comes to inventory, there is one main item that will adjust with inventory, and that is the unrealized profits on closing stock. Remember, we can also adjust our inventory with the goods in transit. Accounts receivable, we adjust it with intercompany owings and the items in transit. So you take the one for X plus the one for Y, you subtract the intercompany owings and items in transit. We also have cash and cash equivalent doesn't have an adjustment. We have ownership capital. We are going to recognize the one for the holding company unless the holding company has issued shares to the public. We have the share premium. We recognize the one for the holding company unless the holding company issued shares to the public at a premium. We have the retained earnings. We use it for the purpose of determining the group retained earnings. Those are the retained earnings at the balance sheet date. We have the trade and other payables. That's okay. Trade and other payables will only be adjusted or affected by intercompany owing, meaning you take the trade and other payables of X plus the one for Y and you subtract the intercompany owing. If you notice, from this question, we acquired we acquired Y many years ago. So we are not going to apportion the incomes and expenses on time basis. Z, we also acquired it more than 1 year ago. So it means we are not going to apportion the group share of profit after tax in an associate. That's simple. Assets and liabilities, whether the post-acquisition period is less than 12 months or more than 12 months, we don't apportion the assets and liabilities at all on time basis. Very important to know that. So additional information. So the approach of attack in this case is, as we read note 1, we try to see the effect to our financial statements. 1, during the year ended 31st March 2015, Y Limited sold goods to X Limited for 3.9 million. So 3.9 million is sales from one group member to another group member. Y Limited made a profit of 30% on the selling price. 420 million of these goods were held by X Limited as of 31st March 2015. On 31st March 2014, X Limited held 180 million of the goods that had been purchased from Y Limited at the same gross profit margin. Now, note number 1, friends, is talking about intercompany sales and unrealized profits. When a group member sold goods to another group member, that is an intercompany sale and should be eliminated. So it means when you're going to prepare a group income statement, we'll take the sales of X plus the sales of Y, we subtract the intercompany sales. Because it was also recognized as a purchase by the purchasing group member, we are also going to adjust our cost of sales by the intercompany sales. In addition to that, there is unrealized profits. You notice that some goods had not been sold by 31st March 2015. But there are also some goods which had not been sold by 31st March 2014. The one for 31st March 2015 relates to unrealized profits on closing stock, while the one that had not been sold as of 31st March 2014, they relates to the unrealized profits on open stock. Both unrealized profits and unrealized profits on opening stock and closing stock will be adjusted in the cost of sales. In addition to that, unrealized profits on opening stock will also affect the computation of the determination of the group retained earnings brought down. You should also remember this. In case this transaction was an upstream transaction, meaning it's a subsidiary that sold to the holding company, then we must adjust the group the profit attributable to NCI accordingly by this item. That is in our group income statement and a group statement of changes in equity. For our group statement of financial position, our inventory will be affected by unrealized profits on closing stock. Now, friends, get that very clear. Our inventory will be affected by unrealized profits on closing stock, not on open stock. So you take the inventory of the holding company plus inventory of the subsidiary, you subtract the unrealized profits on closing stock. Then we have number 2. Now in this case, it means that the 30% is the margin. So you take 30% on the 420 to determine the unrealized profits, or 30% on 180 to determine the unrealized profits on closing and opening stock respectively. 2, annual impairment tests have indicated impairment loss of 300 million relating to goodwill of Y Limited, which included 75 million of the goodwill impaired. In the year ended at 1st March 2015, the goodwill of Z Limited has not been impaired. So we have been told there is a total impairment of 300 million. Out of that 300 million, there is 75 that relates to the current year. So there is definitely the balance, which, if I'm not wrong, is 225, which relates to the previous year. In our income statement, we are going to adjust the 75 for the current year. But in our group statement of changes in equity, for the purpose of determining group retained earnings brought down, we'll adjust our group retained earnings brought down by the prior year impairment loss. In our balance sheet adjustment, we are going to reduce our goodwill by the total impairment loss. Fine. Number 3, the fair value difference of the net assets of Y Limited relates to plant being depreciated over a useful life of 10 years from the acquisition date, while the fair value difference of net assets of Z Limited relates to land. So forget about the revaluation of Z, that's an associate. The revaluation of X, we have been told, relates to an asset that is depreciated over 10 years. This means that there is a depreciation and a charge. Apart from in increasing our assets by 300, then it means that we have been undercharging depreciation. So 300 by 10, we have been undercharging depreciation per annum by 30 million. So for how many years? From 2011, friends, 2011, there is 2012, there is 2013, there is 2014, there is 2014, that's 4 years. So we have been undercharging depreciation for 4 years. So 30 by 4, that's 120. Now, listen to me. In our group income statement, our cost of sales will be affected by the depreciation and a charge for the year, meaning we increase our cost of sales. Secondly, our computation of profit attributable to NCI will be adjusted or will be affected by this depreciation and a charge. Thirdly, our group retained earnings brought down in our group statement of changes in equity will be affected by this depreciation and a charge in the previous year. Fourthly, in our statement of financial position, we are going to reduce our property, plant, equipment by the total depreciation and a charge for the 4 years. That's important. We are going to use it directly. Now, note number 4, Y Limited intangible assets include 261 million being expense incurred on staff training on the use of new technology conducted during the year. The directors of Y Limited believe that the expenditure should be capitalized since the expenses were incurred before the new business had commenced. They have told us about these 261, which was reported as an intangible asset, but this one should not have been reported as an intangible asset. It should have been reported as a distribution expense. That's a training. That training could have been reported as a training of on the use of the new technology conducted during the year. So this one should have been recognized as part of selling and distribution because it's is a staff training. The staff training on the use of new technology conducted during the year. So this is not an intangible asset. We can either recognize it as an admin expense or as a distribution cost, but this one will fit well as an admin expense. So we are not going to recognize it as an intangible. This means we must reduce our intangible assets by 261. It also means that we must increase our expenses by 261 in the group. It also means that the profit after tax of the subsidiary was overstated because the 261 was never reported. This means we must adjust the profit after tax when we are computing the profit attributable to NCI. That's not a problem. Then 5, Y Limited has not issued new share capital since acquisition. Fine. 6, investment income of X Limited relates to dividend received from Y Limited and Z Limited. If investment income of X relates to dividend received, let me go back to it. That's the figure of 780. Then we are not going to consolidate it. Already it will have been recognized because we will have taken the revenue of X and Y. we'll have taken the cost of sales of X and Y. Basically, it means that we'll have taken the group share of profits of of Y. So we don't again bring in the dividend income. We don't, because you're going to recognize the group share of PAT in an associate, then it means we'll have taken into account even the dividend will be included. So we don't again consolidate the dividend income. So that one will be left out. That's good. So we have come to that end of a summary or explanation of what is required. So what we need to do, we only need to do the necessary adjustments. One of the necessary adjustments, we need to determine goodwill. We need to determine goodwill. So I'll come to this point and say working 3. Working 3, let me say group statement of financial position workings. One of the working here is the cost of control. Cost of control in respect to Y Limited. Another one is investment in associate. That is Z Limited. Another one is non-controlling interest account. Some of these items you can work without opening these accounts. You can simply use your calculator and get the figures directly. So that should not worry you. So you come and say these figures are in millions. I'll continue. Okay, fine. Now we start with the purchase consideration, the cost of investment. The purchase consideration in Y is given 22.95. The cost of investment in Z is 609. The balances, the retained earnings, for X Limited, Y Limited. For X Limited, the retained earnings 72.90, 27.87. For Z, we are going to talk about the post-acquisition. Come back to that. Now, we have acquired the net assets 80%. 80% of the ownership capital, 1,200, we were given that. Share premium, 80% of 420. We have a revaluation, 80% of 300. Then we are able to talk about goodwill as a balancing figure. Oh, before that, we also have pre-acquisition, we have pre-acquisition retained earnings. Then we are able to talk about goodwill being a balancing figure. So 80%, you could easily say just 80% of the 2,400, and you could just say 80% of 2,400. Then you say we have purchased it 2295 minus the 1920. 375 could be our goodwill. But now let's do it individually. We have said there is 80% of 80% of 420, 336, 80% of 300, 240. This is 80%. We were given that. It was the pre-acquisition was 480. $384. There is 960 plus 336 plus 240 plus 384. 2295. This is 375. Now we have taken 80% of 1200. So we need to take the 20% of 1200 to non-controlling interest. So owner share capital, 20% of 1200, and that comes to 20% of 1200, 240. We have taken 80% of the share premium. 20% goes to the NCI. We have taken 80% of the revaluation surplus. So 20% goes to the NCI. Retained earnings. Remember, our retained earnings total, out of the total retained earnings, there is pre-acquisition retained earnings. We have taken into account the 80% of pre-acquisition retained earnings. But there is the NCI share of the total retained earnings. Whether there is pre or post, the NCI share of the total retained earnings in the subsidiary will be recognized in the non-controlling interest account. So I come back here. I come back and say that out of 2787, there is pre-acquisition retained earnings that we have taken to the cost of control as part of the net assets. So we come and say there is cost of control in respect to pre-acquisition retained earnings. Out of these 2787, I've removed 384. So how? 80% of 480. That's how we got the 384. It has gone to our cost of control as part of the net assets acquired. Then, out of the total 2787, there is NCI share. NCI share of retained earnings. NCI share of retained earnings is simply the 20% of 2787. So in that case, how much does it come to? 20% of 2787, I'm saying it's 557.4. Confirm that. That's 20% of 2787, 557.4, and that goes to the non-controlling interest. Retained earnings, 20%, 557.4. Now you see how this goes. Very easy. Because what we have simply said, our total